Drew Tignanelli. This is our June update, and we're here with Mikey P as usual.
Yep.
And markets are kind of flattish now. They've kind of like hiccuped for a little bit. But
if you watch the news, they're all over the place. But if you watch the math, they're not.
Yeah. Well, here's the interesting thing, and I've been following markets for 40 years, and the worst thing you could possibly do as an investor is listen to the news as to what they say. For example, yesterday morning, before we taped this show, and this is the 21st, Friday of the 21st of May, and yesterday markets were down in the morning, and the headlines in the market were global sell-off, inflation fears. And I mean, you read that. You would have
3-day trend.
3
days.
You would have woken up and sold every stock you had. If you just read those news reports, plummeting, global sell-off, et cetera, et cetera. By the end of the day, the NASDAQ was up 1.77%. The S&P 500 was up 1%, and so forth. The media looks for exaggerated words to draw you in and to get you to react, to click on their message, to listen to their news story, to watch this video, to do something. And they're not going to get it by saying, yes, the market today is down 0.65%. That just doesn't attract people.
No, not much to say today to everybody. Go ahead, back to what you're doing.
Yeah, I just want to give you the facts. The facts are the market is down today. The market is up today, but they throw those hyperbole words in there to draw you in that, oh, no.
But two things that I guess are somewhat in the news, but we are going to talk about is inflation and taxes, right?
Inflation is definitely in the news a lot. You keep getting the concept, and I'm asked this quite often, is with the federal deficit exploding, with the amount of federal spending and so forth, and the amount of money they're printing, we've got to have inflation. And, the logical answer would be, yes, you would expect inflation, but you're not getting it. And if you go and look at Japan over the last 30 years, they've been borrowing 40 to 50% of their budget deficit every year. Their debt to GDP is up to 250% debt to GDP. And yet they've had one of the lowest inflation rates in the world. And the key is that if you're borrowing the money and you're financing the borrowing with your savings and so forth, which the United States surprisingly is doing to some degree right now.
Right, yeah.
You will not get inflation. It's when you do what Argentina or Venezuela or countries like that did, where they're just basically printing money and handing it out, and there is no control over government spending and how much money they're creating.
Well, I think part of the story that's often gets mistold is about who holds our debt. 78% of our debt as of 2019 numbers was held by U.S. citizens.
Or the central bank. Right.
Yeah.
And that's probably even higher today.
China does make up the bulk of that other chunk, but 70%.
Actually, Japan is the largest holder of our debt, largest single holder. Japan has more debt of the United States than China does. And China's actually been reducing its debt over the years. They only hold like about 900 billion to $1 trillion. And yet our debt's like, what, 20 some trillion now?
Yeah. Well, and I think another aspect of the story that we hear on the radio a lot from listeners is that the inflation that we have seen is being seen in very specific areas, very, lumber and, very kind of categorized areas where we've seen prices really explode where demand and supply have not.
Food and then, and so forth.
Yeah.
Especially where you had disruptions in the supply chain with like lumber, like food and things like that. You've had a lot of disruption in the supply chain, and so you're seeing a lot of price increases in those areas. But actually lumber has been suffering some big declines lately. And so you could be getting to that point where all of a sudden prices had moved up too much that now they're about to head down again because people are coming back to work and things of that sort.
Right.
I'm on the road the other day, and there's more cars on the road. What happened to the COVID traffic? I like COVID traffic,
Everything must come to an end. So the other big topic, I think, is taxes, right? Some tax changes, as well as, what our clients and what other people should be doing when it comes to tax planning.
Yeah, there's this new child tax credit that's coming, and it's really unbelievable how they're going to try to do this. So the child tax credit just a couple years ago was only $1,000.
Right.
And then all of a sudden they raised it to $2,000. And there's a difference between a credit is an actual cash back, and that's important to understand that, when you get a deduction of $5,000, that means that you get to write that off of your income. So if your income's 100, you get to say it's 95. Well, and then if your tax bracket was 25%, you get $1,250 tax savings by a $5,000 write-off, okay, or deduction. But when you get a credit, Mike, and it's $5,000, that's $5,000 of cash that comes back to you. So a credit is far better than a deduction. Now, there's two types of credits. There's refundable and non-refundable. What's the difference? Non-refundable means that if you have a tax liability of $1,000 and you have a non-refundable credit of $1,500, you can only use 1,000 of it to bring your tax down to zero. Now, if your tax was $2,000 and you have a $1,500 non-refundable credit, you bring your tax down to $500 because you can use your full credit against that tax. But non-refundable means you have to have a tax liability in order to take that tax down by the amount of credit that you get. But refundable,
right, which is what the child tax credit is.
Which is portion of the child tax credit is. And the earned income credit and the child tax credit and a portion of the American Opportunity Education credit. These are refundable credits, which means that even if you didn't have a nickel paid in withholding, even if you had no tax liability, if you get a refundable credit, it's cash coming back to you. Cash coming back to you. We had a client this year that had zero tax liability, zero income, and got $3,500 of refundable credits back.
Yeah, the recovery rebates, right?
The recovery rebates, but they also got a child tax credit, and they also got a earned income credit.
So on this new child tax credit, before too many of our clients get excited, the married filing jointly limit where it starts getting phased out is at $150,000, and the individual limit where it gets phased out is $75,000. And I think head of households like $115,000. I don't know that one off the top of my head, but it's $3,000 for children under 6 and $2,000 for children under 17.
Correct. And actually, I think that it's $150,000, and I don't think it's a phase out. I think it's a cliff. We'll have to check that. This is brand new.
It is.
So, but I'm pretty sure it's a cliff at $150,000. And a cliff means that, boom, you hit $150,000, you don't get it.
I think it might be a phase out. So one of us goes, the other one lunch.
Okay, I'll bet lunch on that. I think it's a cliff. He thinks it's a phase out, but we'll check on that, and we'll let you know in the next video. But the point is that you went from $1,000 credit, which was, I think, fully non-refundable, to a $2,000 credit where $1,400 was refundable or is. And now you're going to a $3,000 credit. And if the kid's under 5 years or 6 years of age, it's a $3,600 credit. And it's fully refundable except for that $600 of the original $2,000
You're
credit.
Skipping the most interesting part.
What is?
And they're going to mail it to you by check. Monthly.
Monthly.
Starting this month.
So that means that if you get the $3,600 credit, you could be getting a check somewhere in the neighborhood of $250 a month just sent to you. Now, if your income at the end of the year is too much, you got to give it back to them.
And if you were used to getting that credit to figure out your taxes at the end of the year, you don't have that credit at the end of the year.
That's right. And And so you really have to be careful when they start sending these checks. You got to make sure that you understand, do I deserve this check? And should I keep this check? Because you may owe it back.
Do I deserve it or am I going to get it? But the point is, there's this law. There's another law that I'll just briefly cover. There's change happened late last year, pass-through entities. So if you're a business owner and of a pass-through entity like an LLC or an S corp, there's and you're a Maryland resident, there's a new thing you can do there. There's all kinds of these little things, but the overwhelming point that I believe you wanted to make on today's video is that financial planning and tax planning, the importance of tax planning.
In financial planning, the focus of all true professional financial advisors should be tax planning. It should be tax planning. It's not investments. Investments nowadays are a much more systematic, academically developed portfolio.
Depending on the size of the
a lot assets, of it is index oriented and and so forth. And the concepts are pretty much similar. So if you go to this person and they say they're investing for you, and this person, their portfolios might look different, but in essence, there's a lot of similarity going on.
Depending on how they get paid.
And depending on how they get paid. But here's the point. If this one's giving you tax planning and other comprehensive advice, and this one's giving you nothing more than the portfolio, you're getting ripped off, in my opinion.
Yeah, the value.
Because a true comprehensive advisor should be a tax planner, and with all the nuances. And people think that they go to a tax preparer. Their tax preparer is doing tax planning for them, but that's not true.
Doing tax preparation.
They're doing tax preparation. You give them the information, they take the information, they boil it down, they spit it out. Unless you're a big business owner where you're paying accountants lots of money, are they doing tax planning for you? The average client does not get the tax planning advice that we at the consulate focus on with our clients, and the comprehensive advice that we focus on with our clients. And that's why we're, saying to you that your friends and family who claim they have a financial advisor do not understand what they're missing unless they experience what the consulate has. And that's why the financial physical has always been our way of helping people to understand the difference between who we are and who others are. And we do the full financial physical until somebody actually has to even consider whether they want to pay for it or not.
Sure. Well, and on our existing clients, one of our big asks is that, we send out messages during the year saying, hey, get us your tax return while there's still time to do something about it. But even if you didn't get us your tax return during the tax preparation season that just ended last month when you see this video, get us your tax return now, because, there are changes that can happen that we're not going to see unless we see that tax return. And there's opportunities that present themselves.
Absolutely. And we hope that you always keep us in mind for your friends and family. If they want to experience what a true professional comprehensive advisor should do with tax planning, we can't tell you how many times we have a new client come in and say, the thing I really appreciate is you guys bring it all together.
Yeah.
You do the investments, but you're also giving us all this tax advice and comprehensive advice, estate planning advice. The deficit problem is more of a tax problem for the future than it is a quote unquote inflation problem. At least at this point in time, I'm not worried about inflation. I'm worried about taxation in the future.
Sure.
You should too, and your friends and family should be very concerned about that. Anyway, the consulate has a tax passion to continue to figure out any tax law that's coming down. How does it benefit you and your family? We're very generationally focused, and that's our goal, is to be generationally focused, knowing what's going on up the ladder of the client, what's going on down the ladder of the client, and making sure the family unit as a whole benefits the greatest from all estate and tax planning there is. I think we're out of time. Anyway, this is Drew Tignanelli saying God bless.